Good morning, everybody. Welcome back to Morning Markets on Thursday, the 23rd of April. We've been discussing a couple of themes at our morning meeting that I wanted to share with you. The first of which is the performance of markets over the past couple of days. Clearly, we've seen weakness in markets and then a rebound, particularly in the US yesterday, with most US markets closing up over 2%. And again, that fed through into other asset classes with bond yields backing back up slightly, with the US 10-year moving back above 60 basis points. UK gilts relatively stable at around 31 basis points. It also fed into the currency market with slight weakness in the US dollar. That's primarily because sentiment improved slightly yesterday, and that I think was probably the main driver of the market. Why did sentiment improve? Two things. I think one, around the issues with COVID-19, where we're seeing tentative signs of peaking in the number of cases in a number of markets across the world. And then secondly, just how the oil price did recover somewhat from the very historic moves that we've seen at the start of this week. So that did give an improvement to sentiment. I think also, as we've touched on in these discussions in the past, one of the key things about the current market environment is just the level of heightened volatility that we're seeing, and those excessive movements in share prices and also in bonds. And that is something that we just have to live with, unfortunately, in this current situation. Why is that? Well, ultimately, market participants are trying to really grapple with what is the outlook, and how do economies start to recover from the current situation. That's difficult because ultimately the data that we have is historic, it's old, it doesn't help in that regard at this point in time. And market participants are kind of without an anchor with regard to that. So that's why the market will likely remain to be driven by sentiment, and as a result remain volatile until we start to see evidence of economies emerging from lockdown and what that is meaning for the recovery trajectory. The other thing that we discussed this morning was just the further action, I should say, that the ECB announced yesterday evening, and that will allow the ECB to take as collateral, i.e. to bring onto their books debt that has recently been downgraded from investment grade to junk status. Why is that important? Well, that's very similar to the action that the Fed took a number of weeks ago, and that will help those corporates that do see their debt downgraded as a result of the impact of COVID-19. So that's a positive for keeping liquidity and capital flowing into the Eurozone at this point in time. It also may have been a bit of a precursor to slight concerns that we've touched on in these videos in the past couple of days indeed, as to how we have seen the Italian and Spanish and Portuguese treasury markets move, with the yield that they are commanding relative to Germany starting to move out and widen. The fact is that we do have an S&P review of Italy coming up over the next couple of days, and that may or may not result in a debt downgrade for Italy. So we'll watch that and see how that plays out over the next couple of days. That's it for today. Join me again tomorrow. Thank you very much.